ARDC has a 1-year total return of more than 30%, which is bonkers for a boring credit fund. It also has a long history of consistent monthly distributions, not to mention a hefty yield of 10%. Today we'll look at how this fund generates income and two competing funds that also offer some diversification away from stocks. We can earn juicy yields from covered call index funds like JEPB, FEPB, JEPQ, SPYI, and QQQI, so why even bother with credit funds like this? Well, because I'm looking for consistent distributions. The distributions from covered call funds are a function of the price of the fund. If the JEPI price drops, say, 30% for a sustained period, the distributions will also drop by a similar percentage, depending on the volatility. By contrast, the distributions from these credit funds are not tied to the price of the fund. The distributions are a function of the net income they generate from holding credit securities like bonds. We're here for the income, so let's dive straight into the monthly distributions. There have been cuts over the more than 10-year history, but none of them were really severe. During the pandemic, monthly distributions fell from 11 cents to 10 cents, but they eventually recovered. The recent increases are most likely the result of floating rate loans profiting from higher interest rates. So the obvious question is, won't that reverse when interest rates eventually fall? As we'll see shortly, it's not quite that simple. This fund has quite a few moving parts. By the way, if you're new to the channel, I retired in 2017, and that's when I got serious about researching my investments in greater depth because now they pay for everything, including this trip to Bangkok, Thailand. And by the way, that's a print, not a window. I mostly focus on stocks and funds paying consistent yields of 8% or a bit more, and everything I'll discuss today exceeds 8%. The Ares Dynamic Credit Allocation Fund, ticker ARDC, has 4 sources of revenue: corporate loans, corporate bonds, and 2 types of collateralized loan obligations, or CLOs. Very quickly, a corporate loan is typically a loan originated by a bank who lent to a large corporation. Then ARDC buys the loan from the bank, hopefully at a good price. Corporate bonds are issued by companies to raise capital. The income stream is set, but the price of the bond varies based on market conditions. Once again, ARDC can add value if they buy these bonds when interest rates are high and sell them as rates fall. A 6% bond is nothing really to write home about at the moment, but if interest rates fall, a 6% bond becomes more attractive and its value will increase. CLOs are created by pooling a collection of corporate loans into a tradable security. The thinking is that if a single borrower has a default risk of, say, 1%, the risk of 100 companies all defaulting is far less than 1%. The loan pools are repackaged into tranches based on risk. The debt tranches receive payments of interest and principal, just like any other lender. The equity tranches don't receive those regular payments, but they equate to ownership of the CLO and are entitled to any profits from the sale of the CLO. The equity tranches are the highest risk, highest reward tranches, but these make up less than 10% of the fund. The word dynamic refers to their strategy of adjusting the weighting of these 4 sectors based on market conditions. This diagram shows the basic strategy. My apologies for the low resolution, but this image from the Ares website is the only version I could find. As I record this, rates have been rising, so the fund leaned towards floating rate loans. When rates are expected to fall, they'll weigh more towards bonds to lock in today's high rates, then eventually sell those bonds at a profit. Aside from today's high interest rates, there are 2 reasons why credit funds like this offer such a high yield. Firstly, approximately 90% of the loans are below investment grade, so you're relying on the portfolio manager to underwrite the risk. However, the loans are senior secured, so even if there is a default, they're first in line to collect when the borrower's collateral is liquidated. In other words, a default doesn't mean a total loss. They can usually recover the majority of the principal, as explained in this article by Nick Ackerman. Secondly, the fund is leveraged. The degree varies, but currently it's leveraged by 34%, which multiplies the income, or losses, that they're able to generate. Timing matters for this fund. The 1-year total return is great, but there were long periods where the price declines negated the admittedly decent distributions. So why is that? The short answer is interest rates. This fund doesn't do well in a sustained zero-rate environment, or when the Fed was really aggressively slashing rates. For all other interest rate scenarios, ARDC can adapt by changing the mix of the securities it holds, as explained earlier with that diagram. The management fees are high, 2.58% at the end of 2023. I think that's the highest of any fund that I currently own. The website shows a number more like double that, but that's including interest expense. They hold over 200 securities and trade half of them each year, so it is a lot of work. However, I do understand that some investors won't pay fees that high regardless of the returns. Regarding tax treatment, you can expect ordinary income, no special treats. Apart from the yield, here's what I like about ARDC. This fund comes from the people that brought us Ares Capital, the largest business development company. They have a great reputation, and I continue to hold Ares Capital. That one's ARCC. The 2023 annual report showed that the net investment income exceeded distributions. In other words, the distributions are covered. The annual report also showed that the fund's NAV, net asset value, grew over the course of the year, which is another good sign. ARDC holds over 200 instruments, and the top 10 only account for 10.5% of the fund, so no individual borrower can hurt the fund too much. A lot of my research for this episode came from articles like the one I mentioned earlier. Nick also explains how ARDC has issued preferred shares to lower their cost of capital substantially. It's impossible to cover everything in a 10-minute video, so before buying a fund like this, I recommend using Seeking Alpha for more complete research. I'll link to the article and a discount for membership in the description. A few times a year, Seeking Alpha runs promotions. Actually, if you're watching this before April 3rd, 2023, there's a promotion beginning on March 27th. Anyway, the link will connect you to the Armchair discount, and if there's a promotion, it'll connect you to that as well. Here are the risks and concerns I have about ARDC. A recession, kind of the obvious one, that would lead to higher defaults, which would reduce investment income. The fund price would probably take a hit as well. And following on from that, if the Fed responded to a recession with dramatic rate cuts, it would reduce income from ARDC's floating rate loans. This is a closed-end fund, so unlike an ETF, the price doesn't precisely track the value of the assets. According to CEF Connect, ARDC trades at a 3.5% discount to its net asset value. You can see that the discount gap has been closing. If we zoom out, we can see that compared to the 5-year average discount of almost 10%, the current 3.5% discount isn't actually that cheap, but in the current market, what is? The two other credit funds I've been looking at come from Apollo. AIF is currently yielding just over 10% and has recently outperformed ARDC with a staggering 1-year total return of 41%. That's mostly because it's focused on floating rate loans, which have benefited from higher rates. The market noticed, and it's currently priced just above its NAV for the first time in years. Also note that the distributions have been more volatile than ARDC, which I don't like as much. The distribution chart I showed you came from a dividend tracker called Snowball, which I use to keep track of my current and future income by day, month, and year. Also things like yield on cost, ex-dividend dates, etc. I'll put a link in the description for the Armchair Income discount if you're looking for something like that. The second fund from Apollo is AFT. This one is yielding closer to 11% and has a distribution history similar to AIF. It's also heavily weighted towards floating rate loans. However, this one is currently priced more like ARDC at a 4% discount to NAV. Looking at total returns over the past 10 years, the three funds follow each other pretty closely. AIF has delivered the highest returns, followed by ARDC, and then AFT. ARDC has been on a tear recently, but I don't expect that to continue forever. The fixed income bonds will appreciate when the Fed eventually cuts rates, and much of that has already been priced into ARDC. I bought a 2% allocation assuming that I'll get the yield and maybe nothing more, but that's okay. I'll probably increase that to a 3% allocation. I also put 2% into AFT to diversify among portfolio managers and exposure to the different business sectors that they lend to. They're more heavily weighted to healthcare and business services than ARDC. I'm also open to buying AIF, but at a lower price. This isn't a directional bet on interest rates. I'm just looking for exposure to something other than the NASDAQ and the S&P 500. Speaking of which, I've reviewed a few business development companies that are also in the lending business. Unlike credit funds, they originate their own loans and they're quite hands-on with their borrowers. If you'd like to learn about high-yield opportunities in that sector, I've made a BDC playlist and you can click that over here. That wraps it up for this look at ARDC and credit funds. More armchair income coming soon.